right?
Yeah. Okay.
So those are different asset classes. So actually the authors of this book, they don't want to use the word or phrase asset class. They're saying investment class. They have their own rationale. Now, this chapter is about alternative investment classes. So these include hedge funds, real estate, new ventures, private equity, commodities. Investors tend to believe alternative investments offer opportunities for further portfolio diversification. But they may be very volatile, very risky, right? That is why they usually do not have large allocation. But there are some funds, especially some university endowments, like Yale University has a large endowment, Harvard University have a large endowment, and they have long horizons, long-term horizons that helps them with a significant position in alternative investments, right? Because over a long period of time, the volatility will stabilize, right? So these investments are generally thought of as not very suitable for short-term investment horizon. There are some statistics here. For example, in 2014, 34.7% was invested in global bonds. Equities 31.8%, and rest were in alternatives like commodity, real estate, private equity, hedge funds, real estate being the largest among these four. Probably everyone is very excited about hedge funds, right? Everybody wants to work for a hedge fund because they pay a lot of money, right? So hedge funds, they reflect non-traditional strategies applied to traditional market. Traditional market is like equity, stock market. So that can be one approach, or another approach, they invest in alternative markets, that is different asset classes than publicly traded stocks and bonds. Like, I mentioned real estate. In the 1970s and 80s, typical hedge funds, such as those run by Robertson and Soros. Does anyone know this guy? Have heard of him? George Soros. If I have time, I will talk about him more. He is actually called the guy who broke the Bank of England because he shorted a British pound. Okay, so if we have time, I will give you more information about it. Global macro funds, betting on currencies and investing across markets. So these were the areas hedge funds typically focused on in the 1970s and 80s. But now hedge fund has spanned a broad range of possible strategies. So here is a list of some of them. So if we are talking about equity style, this strategy is long short to exploit perceived mispricing between equity securities. What is long and what is short?
Long is buy, short is sell.
Very good, right? Another way to think about is you are long in a position if you benefit if the price goes up. We say investor has a short position if the investor makes money if the price goes down, right? Rick and I were talking about shorting. You were there too, right? Shorting the technology because a lot of people think they're overvalued. So long short. This is a classic hedge fund strategy: buy undervalued, sell overvalued, right? But still retain a degree of overall market risk. So that means basically, so when you short, what happens? You sell, you get some proceeds, some money. You can use that to finance a long position, right? So you can think of it as no investment required, right? But that will be your market neutral position when construction of portfolios with offsetting long and short position. But in case of traditional classic hedge fund strategy of long short, there is either you are overweighted in the long position or in the short position, right? It is not market neutral. If long and short positions offset each other, it is market neutral. Short bias, you are overweighted in the short position. Another style is called event-driven strategies that seek to exploit perceived mispricing created by identifiable events. One of the events is merger arbitrage. What is a merger? Two companies want to merge, right? So what we have seen in the historical data is, so there is a target company and there is a acquirer company, right? Acquirer is the company that wants to merge or acquire, right? The target, right? So when an acquirer company announces they're going to acquire, let's say, company T, generally what happens, the share price of acquirer goes down, right? One of the rationale is the market participant, like shareholders, think the management probably is building an empire and they're more likely to overpay for the acquisition. When I say building an empire, it basically means, let's say you are the CEO of a company. Now, if your salary compensation depends on how large your company is that you manage, you will want to grow your company, regardless whether it benefits the shareholders or not, right? So that is what we call empire building, right? So there is this skepticism among the shareholders that maybe in case of merger, the acquiring company is going to overpay, right? But on the other hand, target company share price goes up, right? And the rationale there is because there will be now a bidding war. Let's say acquiring company is saying, we will pay $60 per share, but that will not be the final price, right? There will be some negotiation, right? So depending on this, hedge funds can formulate their strategies. So this is what is called merger arbitrage. Distressed or restructuring. Securities of firms that have filed for or trying to avoid bankruptcy through out-of-court restructuring. So a company, let's say, is going through some financial trouble, right? Their bonds are significantly undervalued, right? Because if a company goes into bankruptcy, they don't have money to pay for the full price of the bond, right? Now, if you think, as a hedge fund manager, if you think the market reacted too much, too extremely, let's say the bond price is now 30%. Yes, probably the company has a financial trouble, but it will not be that bad. It probably will go up to, let's say, 60%, 70% once the financial situation recovers, right? Improves. So as a hedge fund manager, you can take position accordingly. Activist. That reminds me what happened with Apple a long time ago, probably like more than a decade ago. Apple had a lot of idle cash, and some shareholders didn't like it because they are arguing, give us the money through dividends because we have investment opportunities where we can generate higher return instead of just our cash, right, sitting idle. And there were some activist shareholders who actually forced Apple to do that. So another style is called relative value, strategies that seek to exploit perceived mispricing between equivalent securities. So convertible arbitrage. So you guys have heard about convertible bond, right? If you buy a bond, if it has a conversion option, then what will happen? You have the call option, right? You have the option to buy or convert your bond into the shares. So what is your motivation as a shareholder? Your motivation is if you think, yes, the company will be profitable, right? So that's why you will like a convertible bond. As a finance manager of the company who is selling convertible bond, what is their motivation? They can lower the interest rate because they are benefiting the bondholders in another way, right? So here the strategy is there should be a relationship between what should be the price when you use the conversion option and what you think the price will be in future, right? So depending on that, you can take your arbitrage position here. Similarly, fixed income arbitrage, buy undervalued, sell overvalued bonds. Opportunistic strategies that seek opportunities across a range of securities using a range of techniques. For example, global macro. So when we say macro, we mean inflation, interest rate, etc. So longer term directional positions across markets based on expected shifts in macroeconomic environment. What will happen to the interest rate in Europe, let's say, versus US? And is there a relationship and can we have an investment strategy? Managed futures are a wide range of strategies that are implemented through various futures instruments. Do you remember what is a future contract?
Yes.
Yeah, go ahead.
So you're making deal with the current price, buying the future.
Yes, so you decide, so when you buy a futures contract, you agree to buy at a price set today, but you'll take delivery in future. For example, let's say, and there are two ways you can use that, as a trader or as a hedger. For example, think about the airlines companies. They consume a lot of jet fuel, right? But the oil price is always fluctuating. So what they can do to hedge the oil price, they can buy a futures contract to take delivery of actual oil, right? Regardless, the price is up or down, right? They want to just hedge their risk. Now, as a trader, what you can do, you don't want to take delivery, right? What you do, you still buy futures or sell futures depending on your conviction, right? Depending on what you think will happen to the price. You just constantly buy and sell before their expiration. Futures contract has expiration, right? So that is a trading aspect of it. The other was hedging. Actual, for example, farmers, they can sell futures contract for their commodities, right? So how hedge funds work? Hedge funds are typically structured as limited partnerships or limited liability companies. Do you know the differences between them? Limited partnerships or limited liability companies? What does this limited word mean?
The loss is limited to what you contribute?
Yes, exactly. For example, think of it. When you buy, we are talking about Tesla. Let's say you buy a share of Tesla, right? And Tesla has a lot of debt, right, on its balance sheet. It goes into bankruptcy. Do you think all those banks will come after you to collect the debt? No, because your liability is limited to how much you paid for the price. So that is why corporations are called, corporations have limited liability, right? But in case of partnerships, they have unlimited liabilities. But there are certain types of partnerships, like limited partnerships, where one partner has unlimited liability, another partner has limited liability, right? Similar idea, limited liability companies. So hedge funds, what they do, they are structured as limited partnerships of limited liability companies that pool investors and hire advisors to manage securities held in the fund. They are restricted to raising capital only from accredited investors. What does it mean? You have to be someone with net worth of $1 million, excluding primary residence, right? Or minimum annual income over $200,000 or joint income $300,000 in each of the last 2 years, and reasonable expectations of reaching the same income level in the current year. So this is to protect investors, so that like investors, various retail investors don't invest in them thinking because they can generate higher returns, so they will take the risk because they can generate higher returns, that is true, but they can also lose extremely, right? So it is not suitable. Hedge funds are not very suitable for everyone.
To spend your savings on it, right?
Exactly, yeah. Now, fee structures. Hedge fund fee structures usually consist of a fixed management fee and a variable performance fee. The management fee is based on assets under management and is typically paid monthly. The performance or incentive fee is charged on returns, sometimes above a specified hurdle rate. For example, incentive fee will apply if the fund generates annually at least 10%. Right? Otherwise, the managers will not get any incentive or performance fee. Company will still get the fixed management fee. That is what is called hurdle rate, and typically have a high water mark. What is high water mark? The high water mark is the highest cumulative return attained by the fund. So, for example, a fund reached 110 million. Next year, it went down to 105 million. So the managers will not get any incentive. Next year, again, it went to 110 million. Still, they will not get any incentive fee.
Based on performance.
Yes, because the high watermark, 110 million, that has not been breached yet, right? So that helps investors because it prevents paying for the same performance, right? So incentive fee is not earned unless the fund return exceeds both the hurdle rate and the high water mark criteria. However, the management fee is collected even if performance does not exceed the hurdle rate or high water mark. That's why you see hedge funds, a lot of hedge funds at least, they just want more money to manage, because that is a sure way of income, right? And that is what we call assets under management, AUM, a very common, what is it called? The short form acronym, right? So hedge funds typically have charged historically 2 and 20, meaning 2% management fee, 20% incentive fee. However, the number of funds charging 2 and 20 has been declining since 2007. There is extreme competition in this industry now. Okay, let us solve a problem. This will be very similar to your homework. In an Excel file. So what do we have? Let's see. So it is saying, consider a fund starting with 100 million net asset value, NAV. It is charging a 1.5% management fee, 17.5% incentive fee with high watermark. Management fee is calculated on the gross NAV at the beginning of each year. Okay, so let's do that. Write down
C plus O.
yeah, 0. So we started with $100 million. So the gross return was 30%. The 30% in the first year, negative 15% year 2, 20% in year 3. So we can calculate our gross net asset value. Now this is our gross NAV ending balance here. So this will be our beginning, right? And okay, so our ending balance for gross NAV, it will be beginning times 1 plus the return. Okay. Now we have management fee percent is fixed 1.5%.
Give the 130,
Which one?
130, 130,000,
This one?
130. No, year 2, is that year 2?
This one?
Year 2, yeah, the one. So we just have to pull across?
Yeah. This one, cell reference. Now, management fee is calculated on the gross NAV at the beginning of each year. So management fee in dollars, right? It will be our beginning balance times our management percent. So let me make it bigger, probably to be easier for you to see.
So year one. I know you got the 100 million. 130 million for year two. That's what I'm talking about.
Sorry, say it again.
I said I know you got the 100 million for the year one,
Mhm.
for the year two and year three.
You put across.
Yeah, I think.
Your work. This means basically you just have to. Yeah, if you change this one, that should also change. Yeah. So now macros also. So that is our management fee. Now, so incentive fee is applicable if the gross ending NAV after management fee exceeds the high water mark, which is the highest net NAV reached so far. Net NAV is calculated by subtracting both management fee and incentive fee from the ending gross NAV, which is the beginning NAV plus the gross return. Okay, because the fund just started, its current year zero gross ending NAV and the net NAV are both $100 million. So that's called incentive fee percent. Incentive fee is 17.5%. Then I'll pull across. Here I will calculate the dollar amount. But to calculate that, I need high watermark, right? Because incentive fee applies after management fee if it exceeds high watermark. And high watermark depends on net NAV, right? So let's call this high watermark and call this net NAV. Now, because the fund just started, they're saying this is equal to our gross NAV at year zero ending. Okay. So Now, high water mark will be max of this net NAV, right? Maximum net NAV reached. So it will depend on the previous year net NAV. Now, but I want to be able to pull it across. So what I'm going to do, I will select another row, another cell, close. But then manually change this one to C again, C, and then log this one. So that for the first one, it calculates only one, right? C10 to C10. Now, our incentive fee will be 17.5% times
High water mark.
so we need a max formula because it is a conditional, right? It is conditional on high water mark. So what I'm going to do, max, open parent, 0. If high water mark is not reached, it will be 0. Otherwise, it will be, it says, applicable if the gross ending NAV after management fee exceeds the high water mark. So meaning gross ending NAV after management fee exceeds high water mark. I know it's complicated. Yeah, confusing, right? So, and close. So what the max function will do here, it will choose between 0 and the result of this, right? If it is negative, that means it did not exceed the high water mark, right? Then it will choose 0. So 0 times D7 is equal to 0. That means no incentive, right? If it exceeds the high water mark, this value will be positive. The positive value will be chosen. That will be multiplied with by D7, right? Then you will get the incentive. Does everyone follow? Okay. Good.
What's the high water mark formula?
High water mark, this one?
Yeah. So the net NAV, are we going to input it manually?
No, this will be
The net NAV. Okay, just okay.
so. Now, how do I calculate net NAV? This is gross ending NAV minus management fee minus excellent incentive fee. There you go. Okay. And all we have to do now, solve this. So this means you just need to widen. And you see here, it was negative return, right? So that's why no incentive fee. Okay. Any questions? No, okay. Now we also want to calculate cumulative gross return, net return, cumulative net return. So what is our net return? So our net return is our net NAV divided by previous, right? -1. So although you see the gross return was 30%, because of management fee and incentive fee, now it is only 23 point something. 23.51%.
Please show the problem.
Yeah. Okay. Now, cumulative net return. How can we calculate cumulative net return? We want to account for compounding, right? So for compounding, open parent 1 plus. So for the first year, there is no previous any return, right? So the first one is just this. But in the second period, it will be open parent 1 plus the previous cumulative times closed parent times open parent 1 plus the current net return -1. We subtracted 1 to find out net return. Otherwise, it would have been gross return, the total future value. So over the 3-year period, this is the cumulative return, right? The fund generated this much. So from 100 million to 129,642,250. Now it was also asking for cumulative gross return, right? So what we are going to do, highlight this part. Did I lose you somewhere? No. Edward, are you good?
No, but yeah, I think I'm not good, but
Okay. So I'll actually pull it down 1 row. And then I will say cumulative gross return. And I can actually copy this, paste as formulas. The gross return higher, of course, from the net return because of the management and incentive fee, right? Did it work for everyone? Yeah. No. Where did I lose you, Edward? Which one are you missing?
Yeah, I'm way back to. I've done the watermark and most of the next, the incentive, I just input the formulas, yeah,
This one,
yeah,
you did this one?
yeah.
Okay. Yeah, this is the most difficult part, right? You're good? Okay, so now let's talk about liquidity features of hedge funds. So I mentioned they are not very liquid. They do not offer daily liquidity like in mutual funds. They at least provide daily liquidity, right? If you invest in an ETF or mutual fund, if you want to sell or buy, you can make a request, and those will be processed daily. And if you buy, or if you want to buy or sell, like exchange traded, you can do anytime during the trading hours, right? Now, hedge fund liquidity can include at least 4 features. One is redemption frequency, when or how often investors can sell their holdings. Notification period, how far in advance investors must indicate their intention to redeem from the fund. Lockup, the initial period over which the investor cannot redeem holdings. Gating means the amount of fund assets that can be redeemed at any one time. The rationale behind restricting liquidity is to allow the fund time to unwind positions without adversely affecting the fund's remaining investors. Liquidity terms vary across strategies, but quarterly redemptions are the mode. So there is an investment strategy called funds of funds. What that basically means, it is a multi-manager structure or a hedge fund that invests in other hedge funds. So I am a hedge fund. There are multiple hedge funds. I want to diversify my hedge funds. So I invest in each of the manager of these hedge funds. So I have become now a fund of funds. And there different types. There are different types. One is conservative, another is diversified, market defensive, strategic. Another type of alternative investment classes is venture capital. Venture capitalists are typically those who invest in a startup or early stage companies, so they take a lot of risk actually. Returns are realized when companies go public or are sold to other companies or investors. Like when Yahoo started or Google started, they started with venture capitalists. Much like hedge funds, venture capital and private equity funds typically are structured as limited partnerships or limited liability companies and are offered to institutional or high net worth investors. VC funds, the venture capital funds, are managed by professionals experienced in identifying attractive business concepts, providing expert business oversight, and selling business once they have gained traction. They tend to concentrate expertise in specific industries such as telecom, computer hardware. The goal of VC firm is to identify enough big winners and avoid enough losers, because it is a very, very risky venture. To generate an overall attractive return, a rule of thumb is VC firms seek at least one very big winner for every 9 losers, right? So you can imagine 10% success rate, right? So how big the return has to be to offset all those 90% failures. Now, private equity. Private equity managers generally invest in privately owned companies or publicly traded companies with the goal of taking them private. So are you familiar with the idea? I mean, you know that when you start a company, it's small, and then if you need more money, you can go for an IPO, right? Initial public offering. So that is called taking a private company to public. Sometimes the reverse happens. Taking a publicly listed company to private. That happened to Dell probably a couple of times, right? There are many regions. Sometimes some private equity companies, they think a publicly listed companies are not being run very efficiently because this company has become, let's say, too big. It has become too bureaucratic, or there is a lot of wastage, or other reasons, right? So they want to buy enough share so that they can take it to the private sector. So private equity funds frequently partner with operating specialists or corporate executives. For example, even the CEO of the company they want to buy, to identify new investment opportunities, advise on a strategy, and implement new business plan. So there is a very famous movie about private equity. It's called The Barbarians at the Gate. It is free on YouTube a long time ago. Very, very interesting. There is a book about that. Interesting. If you have time, you can watch it. It's long. So private equity strategies can take different forms. One is leveraged buyouts, or in short called LBOs. In this case, what happens, the purchase of public or established private companies in highly levered transaction. So the private companies, they want to buy, and for that, they borrow a lot of money. The goal is to restructure the company and improve their profitability and thereby their valuations, typically based on EBITDA multiple. What is EBITDA?
Before interest and tax.
D is for depreciation, A is for amortization, right? It is a common multiple, and this is when we are talking about EBITDA, for example, enterprise value over EBITDA, right? So this is a common multiple in private equity industry. So they want to restructure the company and improve the profitability, and once their valuation improves, they sell, right, to the public. Another strategy that private equity firms follow is growth capital. They provide capital as well as strategic and operational guidance to more established private companies seeking to expand or restructure operations and grow revenues. Distressed. I talked about this a little bit previously. Buying the debt of good companies with bad balance sheets. That is, over-leveraged companies experiencing temporary cash flow problems. Such deals may be structured to include warrants, providing the distressed fund with the potential upside of equity participation. So warrant gives the buyers the option to buy shares at a specific price. So much like hedge funds, there are limited means to gain passive exposure to venture capital and private equity funds. Since these investments are private, outsiders like us cannot gain easy access to underlying investments unless they're a fund investor. Management fees, account minimums, limited access restricts most investors from participating directly. Many firms charge a base fee of 2 to 3% combined with a sharing fee of 20 to 30% of profits. Investors called limited partners, they have limited liability. They contribute capital over time when called by the manager. They are called general partner who are actively involved in running the private equity. Capital is returned when the underlying investments are liquidated, meaning sold. While public equity funds frequently invest in over 100 stocks and turn over 100% a year, private equity funds can hold concentrated portfolios and do not typically reinvest the proceeds of sales. Like in stock, when you buy share of, let's say, Apple, you have the option of reinvest the dividends, right? But in case of private equity, once the company matures and ready to be sold, they sell it, distribute the cash flow to the shareholders. Okay, they do not want to retain. They have a specific scope of work. So investors are committed to contributing a specific amount of funding over time and cannot easily redeem their investments. A typical fund invests over 5 years and then divests for 5 or more years. So it's a long investment horizon, at least 10, sometimes even 20 years. Real estate, everyone is familiar with this, right? So you can invest in real estate directly, right? You can just buy a property, manage it. Not everyone can do that, right? It requires certain level of expertise. If you don't have that expertise, you also have the option to invest in real estate investment trusts. And I'll talk about them shortly. In case of real estate, the goal is to benefit from appreciation of the property, right? Due to commodity inflation. For example, the lumber forests, right? The timberland, the price goes up, right? So an investor can buy a large forest, right? And then plant trees, right? So it is a long investment horizon, right? Yeah, so once they grow, they sell. So that's one, but that falls under real estate, at least as here. Restructuring, for example, old house remodel, and then managed by new people, right? And develop, for example, converting an open land to other uses, build property, right? So a real estate firm will seek investors in a limited partnership or LLC, much like a hedge, venture, or private equity fund. Once assets are committed, the firm may seek out properties that currently reflect higher vacancies and or lower rents, right? They target those they have higher vacancy because they think they can improve the vacancy because of their work, right? Because of their expertise, because of their investment, or increase the rent. Now REITs, real estate investment trusts, they trade on an exchange, right? But if you're an investor, you do not have to be directly involved in running the property underlying a REIT, right? There are people for doing that. The underlying trust company raises capital through IPO, initial public offering, or debt financing, They purchase and manage real estate, charge a fee, and distributes at least 90% of income in the form of dividends. 90%. So that is why it may be suitable for certain group of investors who need regular income, right? It is also highly leveraged. Debt is typically 50% or more of the capital structure. They can concentrate in owning office space or residential buildings or retail property like shopping malls, or providing mortgages even. They have seen phenomenal growth over the recent years as illustrated in Exhibit 11.9. Right? Okay. Now, commodities. So commodities actually can be categorized in different sectors. Under agriculture, we have food, grain, livestock, industrial metals, aluminum, copper, lead. These days, everyone is talking about what? Gold, and there is another phrase, at least US is talking about, US, China, Ukraine. Rare earth, right? Rare earth mineral, yeah, which are needed for many different things, right? So China is one of the biggest exporter. Because of the trade tariff, China kind of blocked exporting rare earth materials. But now they have opened to some extent, right? So these are needed for many different things, cars and semiconductors and whatnot, chips, right? And USA now has a contract with Ukraine because Ukraine is also another important place for rare earth materials, right? So energy. Under energy, we have crude oil, gasoline, natural gas, precious metals, gold, silver, platinum. 2 countries are buying a lot of gold. Can you name them recently?
China.
Yes, and Russia, because they want to de-dollarize their economy because of the trade and other factors, right? And US is also concerned of losing their dollar dominance. So other categories include bonds, forest products, and wool. Now, to invest in commodities, you can actually follow 2 strategies. One is you can purchase them directly on the spot market. You need rice, you go buy rice, right? Or you can buy futures contract, like I mentioned, right? But if you are a trader, then what you will do, you will buy futures contract tied to the spot prices and all the contracts before expiration, right? So that you are not forced to take delivery, right? Huge risk. If you're a trader and you ordered for hundreds of barrels of oil, right? So you don't cancel your futures contract. So now, due diligence. So this is a very specialized type of investment. That's why it is called alternative investment class, right? So due diligence is very, very important. It is also very difficult because of the flexibility involved, flexible structure, all kinds of assets fall under this, right? As diverse as gold, timberland, right? So many other things, and they're not regulated enough. There is lack of transparency. For example, you don't see their prices every day, every second, every minute, like you see for stocks, right? So there is a lot of challenge if you want to do some due diligence to find out the correct price, right? Is it worth buying or investing in this particular alternative investment? So as a result, what happens? You have to build some expertise or hire consultant or invest through funds of funds. So that actually increase your costs. You need to consider both qualitative and quantitative factors. So for example, you need to assess the abilities of management and competitive environment. Can the manager identify and articulate a credible alpha opportunity? What is alpha?
Yes.
Alpha is abnormal return, right? Abnormal return, for example, CAPM is telling you required return given the beta is 12%, but the manager generated 14% with the same level of risk. So the alpha is 2%. Does the managers, is management capable and does it have experience in this market? How much capacity is available within this strategy? How much capacity can the manager handle? Now, quantitative considerations include performance measurement and attribution technique. What is attribution? We discussed last week. And what are the two components of attribution? Attribution tries to find sources of return, whether it came from asset allocation or security selection, right? We are actually going back there today after this chapter. This chapter is almost over, short chapter. Hopefully that will remind you the Brinson model that you did, right? You calculated allocation and selection, right? And interaction effect, right? So that is called attribution. You identify what actually drove the performance, right? What percentage, how much of the total return came through what source. Now, you also need to understand these risks, market default leverage risks. There are several approaches to measure the risk exposures. One is top-down approach, which examines past returns generated by a portfolio. So all you need is just the returns. Let's say over the last 1 year, monthly return. And then you regress those returns on the benchmark. You try to explain your portfolio's return with the return of the benchmark. For instance, if a hedge fund's return rise and fall with S&P 500, a top-down analysis would conclude that the fund has significant equity market exposure. Now, bottoms-up approach are more rigorous. It starts by looking at the actual holdings in the portfolio, each asset, its weights, its characteristics. Remember in the class, I gave you a copy, and then you as a group identified what kind of strategy or style it follows, value or growth at a reasonable price, right?
From the Bloomberg.
From Bloomberg you did, yes, also in the class from a textbook, I also gave one copy. But as long as you remember, that's, yeah. So similar to the idea, you have to look into individual holdings, right? So that is your bottoms-up approach. So as you can understand, it requires more data. And because of the lack of transparency in the alternatives market, it is hard to implement. So that's the end of chapter 11. So take 10 minutes break and then we'll finish chapter 13.
Is it? We can open the.
What do you want
I
to do?
can.
We will start
Yeah,
on
okay.
Saturday.
You wanna start Saturday?
We don't have time. We have to submit on Thursday. I work, you work full time, I work full time.
Okay, what do you wanna do?
So we are going to go back to chapter 13. There was some unfinished business, right? So chapter 13, we used the Brinson model, right? But that model applies only for one period situation. For example, 1 year, 1 month. We want to extend that model over multiple periods. Then we have to use extended Brinson model. That is what we are going to do. So in case of extended Brinson model, what happens? We consider 4 portfolios. One is the benchmark portfolio, one is the active portfolio, our portfolio. So that is not changing. These are not changing. But we also have 2 hypothetical portfolios. In the first hypothetical portfolio, we have the same asset class weight as the actual portfolio, but the same asset class return as the benchmark. The other hypothetical portfolio, labeled portfolio 3, has the same asset class weights as the benchmark, but the same asset class returns as the actual portfolio. So we will construct those 4 portfolios. And then this is how we are going to find out allocation effect, AE, selection effect, and interaction effect. So let us open the Excel file that we worked on last week. Does everyone have this? Yeah, okay. So this is our RB, that means our benchmark portfolio. So our benchmark portfolio is our benchmark weights times benchmark returns, right? So we are just going to use sum product.
Is this one from last week?
Yeah. Does everyone have this?
Yeah.
Okay. So B means benchmark portfolio. These are our weights, comma, these are our returns. Close. What happened?
You're missing the D.
Product. Okay. Now R2, see, R2 gives us allocation, right? This is the way to remember this. Of course, you can write down this formula on your formula sheet. So R2 is used for allocation. So what we have to do, we have to change our allocation. That means use our allocation, use the allocation of our portfolio. That is the way to remember. So some product, our allocation, because we are focusing on allocation effect, comma, use the benchmark return. Close. Okay. Now, similarly, if we are focusing on R3, we are focusing on selection, right? So if we want to find out selection effect, we need to select the returns of our portfolio and use the allocation of the benchmark. We are changing what we want to find out. So some product. So our selection is our returns, allocation from benchmark. Now, our RP is our portfolio. So our portfolio's allocation and our portfolio's return. P means our portfolio. So some product, our allocation.
I think you, the first one is wrong, right? The first one you choose the same. No, yes.
Oh, my bad. Thank you very much. You have very good eyes.
What?
The first one I was talking about benchmark, but I chose our portfolio. Thank you very much. Oh. So this one. This one will be our portfolio. Does everyone have the same numbers? Okay. Now, our allocation is our R2 minus our benchmark.
Can I see the RB formula again?
Yeah. Yeah.
No.
Okay.
It's-
This one?
Yeah.
Okay. Now our R3 minus B. Then our RP minus 3 minus 2 plus B. That is our interaction. Now finally, our total effect, we can directly calculate our RP minus RB. Okay, now this is what we are going to implement in our extended Greenson model. So this is our benchmark, this is our portfolio. So first of all, you know what you have to do here, sum. And then here, portfolio return. So that means sum product of allocation and return. Okay. Now we can copy paste these two formulas into the other places of the yellow block. So meaning copy this, paste here, formulas, paste here, formulas, paste here, formulas. So these are each period separately. Now we have to compound them the same way we did in the previous problem we did. So serially multiply, right? And then finally subtract 1. What I mean, Java, you're good? Yeah. What I mean here, this is compounded cumulative return is equal to open parent 1 plus, we are talking about sector 1. I will scroll up this one times 1 plus. Can you tell me which one I should select now?
Second one.
Huh?
Below second.
So period 2, sector 1 times 1 plus period 3, sector 1. Anything else I need to do? Very good. That is how we calculate compounded return. Instead of just summing that, right? Which is not very precise. Oh, you want to see this?
Yeah, one is, yeah.
And then you can just pull down as formulas.
Same portfolio.
Same for portfolio, yes. You can copy the formula.
Mhm.
Is the answer minus 3?
Say it again.
Yeah, I just want to see the answer. Is it minus 3? The answer. Oh, minus 8.
Make sure you have the same numbers here.
Let's see.
Then I can just copy. Control C. So over 3-year period, this is our return. This is a benchmark return. This is our return, right? Okay,
Only a different answer.
where,
The return, the first one, sector 1.
which period?
Sector 1 return.
but
Another compounded.
compounded here.
Yes.
So you have C3, C10, C17.
Oh, okay, I think I missed the C17, okay.
Okay.
So you pull down,
And then you pull down as formulas, yes. So now
Import total.
this one also, yeah, pull down. Yeah, but as formulas. And then you copy this entire thing, paste here as formulas. So now what we have to do, calculate this. So RB, this is our, this is RB, so RB means return of the benchmark. So which is this, right? Now, for R2, what we have to do, some product. R2 is about allocation, right? So we will use the allocation of our portfolio. And then the return of benchmark.
so for the compound, can I sum it, or I should just pull down?
Pull it down.
Pull down,
You mean this one?
yes,
Yes, pull it down.
I pull it down, but
Yeah, I will have a look.
yeah,
But for now, just go ahead and type this one.
yes.
The first one was RB.
Yeah, this one was RB, which is this. Now, R3, what do you do in R3 selection, right? The selection means you use the return of our portfolio. Allocation of the benchmark. So you change what you want to find out relative to the benchmark. And our RP is this one. Now, so you know what you have to do? Copy as formulas. Up to this, don't do anything here yet. Okay, so copy this as formulas. Now for cumulative, there is nothing previously, right? So we are just going to use these ones. Edward, go ahead and type as much as you can.
Okay.
And then you pull across without formulas, without formatting. Now we have to calculate cumulative, and you know how to do it. So now what we have to do, pull down as without formatting,
Can you go back to cell I3
I3.
and I4?
I just pulled down.
Ah, okay.
Mhm. Then I will copy this, paste as formulas. Right? Do you think I need to do the same thing here?
Yeah.
Yeah. Are you sure? Hmm?
No,
No. What should I do? Yeah,
All of them. Oh, yes. Should you just equal period 3?
exactly. Just equal because these are already accumulated, right? Up to this year, right? So just equal to this. Um, okay. Now, the fun part, right? Allocation is our R2 minus our RB. Selection is R3 minus RB. And interaction is or RP minus R3 minus R2 plus RB. Let me redo. Okay. And our total is just the sum. Total effect, PE. Copy, paste as formula. Then what you can do, copy this, paste as formula, copy this, paste as formula. Okay. Now, what I have to do in this case, it will be a little different. So this will be based on these data. So our allocation effect is our R2 minus our RB. Selection R3 minus RB. Excuse me. Then RP minus R3 minus R2 plus R. Total is the sum.
Could you please show the third
I think the
one?
IE is off, the
IE,
interaction. Yeah,
I,
you have a minus and a positive in there.
Yeah, it's -216, right?
Sorry, which one?
In your formula, in the interaction one, the third, the 8.81,
this one?
you've got.
Oh.
Yeah,
Yeah, this one? Yeah.
you've got a minus and a plus there.
I see, so it should be just plus, right? Okay, yeah, I think that's correct. Let me check though. Java, were you saying the same thing?
Yeah, I was saying the same thing.
Yeah.
Could you please show the cumulative one?
Yeah,
First,
sure, which
Can
one?
you do the first
the
one?
upper, like, period,
This one?
first table from up,
Period one.
This one?
yeah, period.
Yeah.
So it's just,
Yeah, and then you just pull down. Because this is the first period, we don't have anything from prior period. So let me quickly check whether I got the same numbers.
And then second one, you copy those formulas?
Second one here,
Yeah.
copy from.
you actually, yeah, you can copy. And copy. The copy from here. From here.
Remember. Go to.
Yeah, that's it, correct. Edward, how can I help you?
Are you gonna post this one?
This one?
Yeah, I can upload this one, yeah.
See. Because I started getting them from there.
Oh.
Yeah, so my suggestion is whenever you need, just do as much as you can.
Yeah, and some,
Yeah, let's see,
I got different numbers.
Yes, we start from the compounded value. So then we give the same, but for the same, almost like this one. Seems just like we can see.
Oh, wait, there's, where do they come from? So I just got, you could just grab.
C17.
Your funds there.
So. Just think if we had a 6 and yours is 9. 5. It's a 1.
Bring down the one of these trees, it would show like this.
Yeah.
Something has changed. Yeah, something has changed here.
What are those? I found.
Actually, this is,
Do these.
I believe it is just because of your,
Start with your period.
yeah, because the formatting somehow changed already.
That's why I couldn't get it.
Yeah, that's why my suggestion is keep working on and then you can fix the others. So here,
This one? Yeah, yeah.
yeah, I can show you from here.
Okay, yeah.
Let me know when everyone is done. So that I can move on to the next one. This one you want to see?
Yes.
Just switched up. Murder, if you're, you switch to.
And you pull down?
No, no.
Some product.
No, you should be. Do you mind this one?
What is the answer? Can I see the answer?
Please?
Yeah.
Okay.
You're good?
Yeah.
Right, there we go.
So Edward, I will upload this,
Yeah,
okay?
yeah.
I want to cover a few more things. Hopefully we'll be done by today. And then next week you will present, and then after I will do a review, right? So. Okay, now from the same chapter, chapter 13. So. I talked about performance measurement, I talked about performance attribution. And we implemented a model for performance attribution, which is called Brinson model. And then Brinson extended model, right? And then performance appraisal, which is just the evaluation of performance results and analysis to determine if the manager has demonstrated a skill. That is where returns due to a greater market risk or to the asset class and security selection. So now when we talk about performance measurement, what we do, we want to calculate portfolio return, right? Okay. There are two ways to calculate returns. One is mark to market. We use market price in simple words. For example, the closing trade price is most commonly used for pricing exchange traded equities, right? And the average of the bid and ask prices is typically used for unlisted issues. Now, some securities do not trade very actively, right? So then we can use mark to model. The previous one was mark to market. We have market prices available. Mark to model is based on a valuation model. The idea is to infer a fair value and estimate of the most likely price at which the security could be traded in the market. So this approach is used when a security is not publicly traded or is illiquid and does not trade actively. This model addresses the issue of timely pricing for securities that do not trade actively. However, the problem is accuracy. The implied price is only as good as the model. Furthermore, even if the model is applied diligently and in good faith, model prices can differ significantly from realized market prices. It is like you are using CAPM, capital asset pricing model, to find out required return, right? But your actual return obviously will be different, right? So depending on how good your model is, your pricing will be that the accuracy of your pricing will differ. Now, there are two approaches to follow to calculate return. One is time-weighted return. Another is dollar-weighted return. So you may be thinking, we are talking about return. Just take the current price minus the previous price divided by the current price, right? Yes, of course. But when you focus on the details, the way you calculate returns can misrepresent performance. So these are the two ways of calculating returns. Time-weighted returns, they are not sensitive to the timing and amount of contributions or redemptions. So what does it mean? Let's say I'm a portfolio manager and I have a portfolio actively managed ABC. Now, Preston invests with me, right? But he invests whenever he feels like, meaning whenever he has cash, let's say. He has cash, let's say $10,000, he invested. And after 1 year, he needs money, he redeems $5,000, right? So this inflow and outflow is beyond my control. So if Preston wants to evaluate my performance, he should follow time-weighted return because my performance will not be affected by something that he controls. What is the flow, right? And that is why actually time-weighted returns is used when the portfolio manager does not have any control over the flows. However, the need to value the entire portfolio on every cash flow date increases both the administrative costs and the likelihood of pricing error. But it is the recommended way to calculate returns. Another is dollar-weighted return, which is basically just the internal rate of return you calculate. And everyone knows what is internal rate of return, right? You have seen this in corporate finance and probably also in investment. So this is sensitive to the timing and amount of flows in and out of the portfolio. If the manager controls the cash flows, it is appropriate to include this impact. Then you should use dollar-weighted return. It has the advantage that valuations are required only at the beginning and end of the evaluation period, not like every time cash flow is coming in, going out. Complexity is that there are both contributions and withdrawals, that means sign reversal during the evaluation period. If that happens, the IRR calculation does not have a unique solution due to properties of math. However, in many instances, there will be only one relevant choice after discarding extreme or otherwise unreasonable results. For example, you calculate return as per dollar-weighted return, meaning IRR, you find -5% and 10%. Which one should you choose, right? Both are feasible solutions based on IRR due to the nature of the math involved, right? In fact, the number of sign reversals is equal to how many solutions you will get. But you can look into the cash flows and actually logically deduce which one should be acceptable. If we have time, then we'll solve this problem. Let me move on. Now, in terms of assessing risk, there are two types we talk about most of the time. One is systematic risk, also called, one is whether they capture total risk or only so-called systematic risk. So total risk is your standard deviation. Systematic risk is a market risk, which is captured by beta. So if you subtract systematic risk from total risk, what kind of risk do you get? Does anyone remember? Total risk is the sum of systematic or market risk plus firm-specific risk. It is firm-specific. That is why when you diversify your portfolio, you can actually eliminate most of the firm-specific risk and left to it only beta, the market risk. So that is one way to think about risk. Another way, whether both upside and downside return variations are considered risk. symmetric measures. For example, standard deviation, right? Standard deviation captures whether individual return higher or lower than the mean return. So it is symmetric. It examines both upside and downside. But there are some measures that focus on downside variations. These are called asymmetric. They're just ignoring one aspect of the distribution. So standard deviations, symmetric. Standard deviation measures the total variation around the expected value or mean of a random variable, is the most heavily used measure of investment risk. If returns are normally distributed, the standard deviation embodies all there is to know about the dispersion of returns, variation of returns. For other probability distribution, the standard deviation is a useful but incomplete measure of dispersion. Beta, I already mentioned, beta measures the sensitivity of an asset's return to a benchmark. For example, S&P 500. You're okay?
Okay.
For example, if your stock has a beta of 1.2, it implies that on average, the asset's return increases or decreases by 1.2% for each 1% increase or decrease in the benchmark return. According to CAPM, we can eliminate risk that is not associated with the benchmark, that is the market through diversification. We can eliminate risk that is not associated with the benchmark. The risk that is associated with the benchmark is called the market risk. We can do that through diversification. So if a portfolio being analyzed is sufficiently diversified, we can consider only the systematic risk measured by beta. Okay, I mentioned that already. Asymmetric risk measures. The main limitation of asymmetric risk measures is that they assume investors have a symmetric notion of risk, meaning upside variation and return is viewed the same way as downside. But academic research and practitioner observation is that investors are more concerned with downside risk. Nobody is sad when their share price is going up, right? So that is why we need to actually need some asymmetric measures. This asymmetry in the perception of risk become more important when we consider the fact that realized returns are not normally distributed. That is, there are too many observations in the left tail and right tail of the distribution. These are some asymmetric risk measures. Shortfall probability. What is the probability that my portfolio return will be less than a specific value? It could be 0 or it could be 5%, right? Lower partial movement, value at risk. So what is lower partial movement? It is similar to variance. What is the relationship between variance and standard deviation? Square of?
Standard is square root of variance.
Yes, right. So it is similar to variance, except that deviations are calculated relative to a threshold return that need not equal to the mean. And only variation below the threshold return is considered. I'll show you when I calculate this, okay? Value at risk. VAR focuses exclusively on the lower tail of the distribution. It is a minimum dollar loss that is expected to occur with a given probability over a specified period. For example, if an investment is expected to lose at least 1 million on 1 out of every 20 days, which means 5% of the time, then its daily VAR at the 5% level would be -1 million. So it is a minimum loss, not the maximum loss. So if we apply normal distribution, if we are talking about 5% bar, so let's say this is mean and these areas is 5%, right? What is the value of this? If we go further to the left, it will have larger negative, right? So that's why it is the minimum loss, not the maximum. Because as you move farther to the left, it becomes more negative, so more loss. So the main advantage of downside risk measures is that they're more in line with the way individuals think of risk, right? We are sad or we are more concerned whether our return will go down or not. A major disadvantage is that the mathematics of portfolio allocation is far more complex. We have simple formulas relating portfolio variance and portfolio beta to the variance covariance matrix of the individual securities. However, there is no such simple relationships between downside risk measures for individual securities and downside risk measures for a portfolio of securities. What that basically means, when we constructed the optimal portfolio, remember, what did we use? Standard deviation as measures of risk, right? So that is very easy to track, easy math, but our math has not developed that much yet that we can use downside risk. Now, when we measure performance of our portfolio, we need to select a benchmark, right? If you do not select the benchmark correctly, then your performance analysis will not be correct either. Let's say I am a portfolio manager, I specialize in value stock. So my benchmark should be a passively managed value portfolio, isn't that right? You cannot compare my performance with a passively managed growth portfolio, right? As an active manager, you want to see, did you make money by investing with me instead of just passively following some value stock, right? So that's why you need to choose the benchmark in a diligent manner. A well-designed and well-selected benchmark should have the following 4 characteristics. Should be identifiable, the constituents and their weights within the benchmark are clearly defined. For example, let's say Russell 2000 is a small cap index, right? So if I am a portfolio manager, I'm saying I specialize in identifying undervalued small cap stocks, then Russell 2000 could be a good benchmark for me because I will select my stocks from that universe, right? Assuming Russell 2000 includes all the small cap stocks. It has to be pre-specified, right? If you want to evaluate my performance, you have to tell me against which you will measure my performance in the beginning, right? You cannot, after the performance, tell me I will now evaluate your performance against this. It has to be investable. Like Russell 2000 is investable, right? I can pick individual securities based on my research and invest in them. So it has to be investable. The portfolio manager needs to be able to invest at reasonable cost and in amounts commensurate with the size of the managed portfolio. Representative, the benchmark captures the investment universe and overall strategy of the portfolio being evaluated. So when we want to analyze performance, then there is one approach called returns-based analysis. So in this analysis, performance attribution is done by examining the actual returns of a portfolio. It is similar to the idea of a top-down approach we discussed in chapter 11. Remember chapter top-down and bottom-up approach. The key advantage of this approach is that it requires only returns data. The disadvantage is that it is an imprecise tool. And there are some reasons why this is imprecise. In the interest of time, I am skipping them. Now, so you have selected a benchmark. Now you want to evaluate performance. So you need to calculate risk-adjusted return for your portfolio. What that basically means, if I'm a portfolio manager and come to you, tell you that my portfolio generated 20% return. Of course, you will be happy, but your question should be, how much risk did I take, right? If another portfolio manager taking the same amount of risk generated higher return, then I am not as well as you thought initially, right? That's why you need to focus on risk-adjusted return. One of the way we can do this is calculate Jensen's alpha. Jensen's alpha abnormal return. What you do, what does this formula remind you?
The portfolio return, expected return.
But what does it have a specific name, a model?
CAPM.
Exactly, capital asset pricing model, right? So based on CAPM, how much return you require, how much is the actual return? So that is your alpha, more specifically Jensen's alpha. If it is positive, the portfolio manager performed well, right? Negative, it did not perform well. It lost money, right? Now, the problem with Jensen's alpha is it just gives you an absolute amount, meaning alpha is 2%, alpha is 3%. But there is no way to know how efficiently that alpha was generated. How much risk was involved for each unit of return, or in other words, what was the return for each unit of risk? That's why we focus on some risk ratios. One of them is Traynor ratio. What you see, we are calculating excess return per unit of systematic risk, right? That is called Traynor ratio. The asset with the higher Traynor ratio should be preferred. Traynor ratio focused on beta. Sharpe ratio, another kind of ratio, focuses on what is this risk? Beta is systematic risk. This is sigma is standard deviation, which measures total risk, right? Right? Sigma is the total risk. So now, Traynor ratio versus Sharpe ratio. So basically, what it is telling you here, if you have a diversified portfolio, then your total risk is actually very similar to your systematic risk, because firm-specific risk is diversified away, So then you can actually use Treynor ratio, which uses beta, systematic risk, as a measure of risk. But if your portfolio is not diversified, there is significant amount of firm-specific risk, you need to use Sharpe ratio, which uses total risk as a measure of risk. M squared. So like the Sharpe ratio, M squared is based on total risk. However, M squared is not a ratio. Like Jensen's alpha, M squared measures an absolute level of risk-adjusted return. Formally, this. So what that basically means, in case of Jensen's alpha, you focused on beta, right? Because you used CAPM to find out required rate of return. Now, what you are essentially doing here for M squared, so this is your portfolio RI minus risk-free rate divided by sigma I, right? Your portfolio total risk. You are finding out, with this, you are finding out excess return per unit of total risk. Do you agree? Excess return per unit of total risk. This is excess return, this is total risk. So this part gives you excess return per unit of total risk. Now you scale this up. That means you scale the total risk such that the total risk of your portfolio is the same as total risk of the market. So what should be the return? Excess return, right? And then you add the risk-free rate. That will be your total return from your portfolio, such that your portfolio has been levered or scaled up or scaled down, so that your portfolio's total risk is the same as the market. Then what will be your return? This is the total return, and then you subtract the market return. So essentially you are using, it is a Jensen's alpha, but here you are using total risk as a measure of risk instead of beta. A positive M squared means that the portfolio has a higher Sharpe ratio than the benchmark. Sortino ratio, we are almost done. And I will not solve any problems. If you still have energy, next class, just give me half an hour, I will solve one more problem, or okay, after the presentation. Or I will do that after you come back from Thanksgiving, whichever you guys like. So Sortino ratio is a variation of the Sharpe ratio. There are two differences between these two ratios. Sortino ratio considers downside risk rather than total risk. That is, it measures risk as a downside volatility rather than a standard deviation. And it measures excess return relative to a target or required return rather than relative to the riskless rate. So in Sharpe ratio, you find out excess return, right? Excess return is your portfolio return minus the risk-free rate. But in case of Sortino ratio, it could be any target, right? It doesn't have to be riskless rate. This is the formula for Sortino ratio. Your portfolio return minus the threshold or target return, it could be 0% if your target is, I don't want any negative return. Or it could be, let's say I want minimum 5%, so it should be 5%. DR means downside risk, which is just the square root of lower partial moment, LPM. So it is useful when the return distribution is inherently non-normal. Information ratio. It is defined as the portfolio's active return relative to a benchmark divided by its tracking error risk. Tracking error risk is the standard deviation of the active return, that is the difference between portfolio and the benchmark return. Higher the information ratio, higher the excess return of the fund given the amount of risk involved, and better the fund manager. IR is particularly useful in enhanced index application where the objective is to match the risk of the index but generate higher return. It differs from the Sharpe and Trainer ratio in that it compares performance of the portfolio to the benchmark rather than to the risk-free asset. I will stop here. Okay, so you have to go a little fast.